Welcome to StokTok's deep dive into Rio Tinto. Rio Tinto is one of the world's largest diversified mining companies, with operations across iron ore, copper, aluminium, and other commodities critical to global infrastructure and energy transition. The company generates revenue by extracting and selling raw materials to steelmakers, power generators, and industrial manufacturers globally. As of May 8th, the stock is trading at $120 per share. Over the past 52 weeks, Rio Tinto has traded between a low of $63.55 and a high of $129.22, placing the current price near the upper range of its recent trading band. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Rio Tinto operates in a commodities-driven sector where competitive advantage derives primarily from asset quality, cost efficiency, and access to geographically concentrated mineral deposits. The company's moat is rooted in its portfolio of long-life, low-cost mines in established jurisdictions, its operational scale, and its ability to weather commodity price cycles through disciplined capital allocation. Revenue is generated through global commodity sales. Iron ore comprises the largest segment, followed by copper, aluminium, and other minerals. The customer base is diverse, spanning steelmakers in Asia, automotive and aerospace manufacturers, and renewable energy companies. The StokTok score for Rio Tinto is 32 out of 100, which signals caution across multiple dimensions. Breaking that down, valuation scores 4 out of 20, financial health scores 11 out of 20, profitability scores 13 out of 20, growth scores 4 out of 20, and smart money scores 0 out of 20. This composite score reflects structural headwinds in both valuation and growth. Now, valuation. The question every investor has to answer: are you paying the right price? Rio Tinto is currently trading at a trailing 12-month price-to-earnings multiple of 19.72 times. The forward price-to-earnings multiple, which projects next year's earnings, stands at 14.57 times. This forward multiple appears discounted to the trailing multiple, but the picture becomes clearer when we examine the PEG ratio, a valuation metric that divides the price-to-earnings multiple by expected earnings growth. Rio Tinto's PEG ratio is 184.4, an exceptionally high reading that reflects significant concerns about the company's earnings growth trajectory relative to its current valuation. The enterprise value to EBITDA multiple sits at 9.39 times, which is moderate for a diversified miner, but must be contextualized against the company's growth outlook. On a price-to-sales basis, total market value divided by annual revenue, Rio Tinto trades at 3.06 times sales. Our DCF, or discounted cash flow model, which projects all future cash flows and discounts them to today's dollars, suggests the stock is trading at par to intrinsic value, with a margin of safety of 0%. This tells us the market is pricing in limited upside or downside relative to our fundamental view. Market sentiment around Rio Tinto leans neutral, with the company receiving analyst attention following recent production results and appearing in broader market discussions about mining stocks. However, negative headlines suggesting investors overlook Rio Tinto in favor of competitors, combined with mining sector headwinds from global macroeconomic tensions, offset gains from positive regional market movements. The next earnings date is February 19, 2026, which will serve as a near-term catalyst to watch. Synthesizing valuation signals, in our view, Rio Tinto appears fairly valued to modestly overvalued at current levels, leaving limited margin of safety for the prospective investor. Moving to financial strength, how solid is the foundation? Rio Tinto's Piotroski F-score is 4 out of 9. The Piotroski score is a 9-point health checklist that evaluates profitability, leverage, liquidity, and operational efficiency. A score of 4 indicates meaningful deterioration in one or more financial dimensions, likely driven by stagnant profitability or rising leverage. The Altman Z score, which uses 5 financial ratios to estimate bankruptcy risk, stands at 3.27. This places Rio Tinto in the safe zone, above the 3.0 threshold that signals elevated distress risk. On the debt side, Rio Tinto's cash-to-debt ratio is 0.32, meaning the company holds 32 cents of cash for every dollar of debt outstanding. This is a constraint. The company is not sitting on fortress cash balances. However, the interest coverage ratio, which measures how many times operating earnings cover interest expense, is 8.44 times. That is a healthy reading, indicating Rio Tinto generates sufficient earnings to service its debt obligations comfortably. The current ratio, a measure of short-term liquidity, is 1.44, suggesting the company has $1.44 in current assets for every dollar of current liabilities. That is adequate but not exceptional. Debt to equity stands at 0.38, meaning for every dollar of shareholder equity, Rio Tinto carries 38 cents of debt. This is moderate leverage. In summary, Rio Tinto's balance sheet is safe but not fortress-like. The company can service its obligations, but it lacks significant financial cushion. Next up, profitability. Is this business actually making money efficiently? Rio Tinto's return on invested capital, or return on invested capital, the earnings generated on every dollar of shareholder equity and debt capital deployed in the business, is 10.59%. This is a respectable but not exceptional return, and notably lower than the long-run cost of capital in most developed economies, a sign that marginal capital deployment may not create shareholder value. The gross margin, which measures earnings before operating expenses and depreciation, is 57.43%. This is strong and reflects the company's pricing power in commodity markets. However, the operating margin, gross profit divided by revenue, is 26.8%, indicating that significant operating expenses and depreciation eat into gross profit. The net profit margin, the bottom line, is 17.29%, meaning Rio Tinto converts roughly 17% of every revenue dollar into net earnings. That is acceptable for a commodity business. The free cash flow margin is 7.8%. Measuring the cash the company generates after capital expenditures. This is where Rio Tinto shows constraint. Only 7.8 cents of every revenue dollar flows to shareholders after reinvestment. The profitability stack tells a story. The company generates strong gross returns from its mines, but conversion to true free cash is limited by capital intensity and operating expenses. The structure is profitable but not capital efficient. Onto growth. Is this business expanding, and at what rate? Rio Tinto's revenue growth over the trailing 3 years is 1.8% annually. Over the trailing 5 years, revenue growth accelerates modestly to 5% annually. These are anemic figures for an industrial company, essentially flat to slightly positive, reflecting the commodities-driven nature of the business. Mining volumes are constrained by geology and mine life, and price cycles dominate earnings but not necessarily revenue trends. Book value, the accounting measure of shareholder equity per share, has grown 3.8% annually over 3 years, which lags even revenue growth and suggests the company is not reinvesting retained earnings at attractive returns. The dividend yield is 3.41%, a meaningful yield that indicates Rio Tinto is returning substantial capital to shareholders, though this also signals limited reinvestment for growth. The growth picture is one of a mature commodity producer with limited organic expansion opportunity. The company is not entering new markets, developing new products, or capturing market share at meaningful rates. Instead, Rio Tinto is a cash generation and capital return story. Management's capital discipline is reflected in the dividend, but the growth scorecard is decidedly challenged. Now let's talk smart money. What institutional capital is actually doing with this name? Rio Tinto currently has 0 top-tier gurus holding the stock, according to our tracking. This is a significant red flag. The absence of legendary institutional investors, the names that typically lead in-depth due diligence and patient capital deployment, suggests that the detailed fundamental case has not resonated with the most disciplined allocators. Insider ownership at Rio Tinto is 0.0%. This means management owns essentially no shares of the company they operate. This is a notable misalignment between management and shareholder interests. When executives have minimal personal capital at risk, they may optimize for metrics like absolute profit or revenue rather than shareholder returns and return on capital. Over the last 3 months, there have been 0 insider buys and 0 insider sells. The complete absence of trading activity by insiders, whether buys or sells, is unusual and suggests either that there is no meaningful optionality or conviction by management on the stock's valuation. Compare this to growth companies where insider buying often signals undervaluation, or to cyclical names where strategic insiders time purchases around cycles. Rio Tinto shows none of this. The smart money scorecard is essentially blank, which in portfolio management we interpret as a cautionary signal. When the world's best investors and the company's own leaders are not putting capital to work in a name, it warrants scrutiny. And finally, the verdict. Let's bring it all together. On valuation, Rio Tinto trades at a fair multiple, but faces a high PEG ratio that reflects minimal expected earnings growth, a valuation that leaves little room for disappointment. On financial strength, the balance sheet is solid and safe, with adequate leverage and interest coverage, but the company is not building fortress reserves. On profitability, Rio Tinto delivers respectable net margins and strong gross margins, but the company is constrained by capital intensity and low free cash flow conversion. On growth, the business is mature and commodity-driven, with revenue growth in the low single digits and no meaningful expansion catalyst in sight. On smart money, 0 top-tier institutional investors hold the name, and management owns no shares, suggesting limited conviction from the most disciplined allocators. Synthesizing these signals, in our view, a fair value range for Rio Tinto sits between $100 and $125 per share, representing approximately 0 to 4% upside from current levels. At $120, the stock offers minimal margin of safety and demands perfect execution to deliver shareholder returns. The case for Rio Tinto rests on the assumption that commodity prices stabilize, mining volumes hold steady, and management returns capital efficiently through dividends. The bear case rests on extended commodity weakness, the structural maturity of the business, the absence of insider conviction, and the competitive inertia that characterizes commodity mining. The broader macro headwinds from global tensions and economic uncertainty add risk to commodity prices, which are Rio Tinto's primary earnings driver. In our view, the risk-reward at current levels skews modestly toward caution. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Rio Tinto. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.